Thank you. Thank you very much. Once again, want to take this opportunity to welcome you to the group. And hopefully we share with you the results for the group's half year, and hopefully maybe dialogue on what the result speaks to. And if we really go straight, microeconomic environment, we have tried, instead of the traditional way of giving you 2-minute slides, we have packed the slides as an appendix. You still have them, 22 slides of that. But we just speak to our interpretation of the microeconomic and the operating environment. And we see emerging very stable microeconomic environment. Interest rates, low and stable. Inflation, low and stable. And exchange rate, fairly stable. So that creates an environment where planning can be done almost with predictability, and almost intent can be pursued in a stable environment. And that cuts across the whole East African region. When we look at the impact of that, we see for a time now a very significant push in terms of GDP growth rate across the region. Something we haven't seen for quite a long time. If we look at the projected 2018 growth rates of GDP, even Kenya is above 6, catching up with Tanzania at 6.8. Kenya will have overtaken Uganda, which is at 5.8. When you then look at Uganda, Rwanda 7.2, it means that the East African region will be above 6%. I will place East African region as one of the fastest growing region, if not the fastest in the world. And as a group, we are lucky to be operating in all the East African countries. And that really then, one would say, any boat that was the water, as the water level rose, it has been raised. And we expect that that gives us a significant opportunity as a group and makes pretty easy. I think second aspect that emerges, other than microeconomic stability, and then growth significantly driven by the private sector, we also see possible sustained growth because of massive investment in infrastructure in the whole region. All the countries are competing for infrastructure development, whether it's standard gauge railway lines, whether it's roads, whether it's airports, all the infrastructure, the enablers of the private sector, that is where the game is. And that, again, gives us huge prospects of sustained growth, maybe for nearly 5 years, because the growth is already high, and then massive investment in infrastructure. So if you look at the growth is being driven by the private sector, then the public sector adds fuel on the supply side by investment in infrastructure. The third factor that we are really impressed with most is the political risk. It appears the whole region, the political risk has declined significantly. For the next 3 years, it appears there is no country that will be going to political electioneering. The last 2 years, we have seen Tanzania, Rwanda, Uganda, Kenya hold their election. So we'll be next 3 years without politics or electioneering politics in the region. And that brings a lot of calmness in the region and focus on the economic aspects within the region. But more importantly, it's not just electioneering, but we are seeing a new trend where politics is acquiring a different shape. If you look or face, if you look at the recent events in DRC, the recent events in South Sudan, the recent events in Kenya as regards politics, it appears that the political game has changed significantly, diminishing significantly the political risk. And for the East African region generally, politics has always been a significant risk. A couple of other issues as factor number 4 is the recent focus now not just exploration, but exploitation, early exploitation of oil and gas. We have significant oil gas fights in Tanzania. They've started exploiting them. Kenya has started tracking its oil for the first shipment. Uganda is busy signing the last contracts. And that again gives us the momentum that if the whole region become an oil and gas region and that resource is exploited, significant inflows, particularly the structure of the economies, will change dramatically because the import-export trade-off will change significantly, particularly if we're able to use oil to substitute the imports, or even better, export some of the oil, and we start the exchange position. Reserves will change significantly. So we see those 5 factors as really creating a very promising present and maybe a better future. And for a company of our size, playing within the region, with our size of nearly 550 billion shillings of funding, it couldn't have been better. So that is what we see. And incidentally, also visibility globally. We see particularly Kenya, the ease of doing business. Over the last 5 years, we've moved from number 129 to number 80 globally, making strides and improving position by 50 position is fairly significant. We have seen a significant rebound on sectors like tourism, export. So essentially, the flows of capital, particularly in Nairobi, private equity, the type of funds that are flown in Nairobi are significant so that we can sustain the exploitation of the opportunities within the region. So that basically is the microeconomic environment we are coming from. The last 2 years, we have talked a lot about headwinds, but it appears now we are at the end of those headwinds. For us in the banking industry, and particularly we really care about financial inclusion, the proposal to repeal the interest capping using the finance bill would not come at a better time. Macroeconomic environment positive, economic activity, activities robust, and then risk pricing becomes possible. So 5 factors make us very bullish about the future. As a result, we have reorganized ourselves as an organization. We've changed slightly our governance structure because the organization has become more complex, but more importantly, we are structuring ourselves to take advantage of the opportunities. And today I'm very, very privileged, maybe as I unveil the organization structure and the way we have aligned ourselves to introduce a couple of leaders who hopefully help us. And the first one, the big change that has occurred is that we have been able to create an executive position, an executive director. I want to ask Mary maybe to come forward. And Mary has now been designated to lead the onslaught on growing the subsidiaries. So she joins the board of the holding company, but with a mandate of driving the growth and development and the day-to-day oversight of the subsidiaries. We think they are of size and they need to be given special attention. The second person designated, of course, is Batesh, Chief Operating Officer, now given very laser-sharp responsibility to look at the supply side. That is really land the back office of the whole group. That is look at finances, look at infrastructure, look at execution of projects, look at the IT applications, look at data and analytics that goes all with it, and ensure the bank, the back end, is as good as it could be. And the third one is Polycarp. And this time, I think it's the first time he's officially joining us in an investor briefing. And Polycarp has been given the mandate as the Chief Commercial Officer and spearheading the marketplace, the demand side. When Batesh deals with the supply side, the demand side has and you can't get a better person on the demand side, the marketplace, like a former chief executive of an FMG. So he really understands the market, the way the market is organized, and each of them has a couple of directors reporting to them. Polycarp will have the group treasury director, so the treasury aspects of the market, the corporate banking director, the group SME director, the group customer experience, and product management. So everything to do with the marketplace, that it will now be really focused, and that really is the leadership that has been given the opportunity as we reorganized ourselves. So maybe now, I think now people will ask you direct questions. I was preparing them for specific questions, so maybe thank you very much. So that is the reorganization that has happened within the group at the very top, so that there is specific responsibilities assigned to each, and we have reorganized. The business model hasn't changed, because since interest capping, we wanted to take a new model which has worked very well, has uniquely helped us to separate ourselves from the pack and demonstrate capability and competence of management. So this is now the business as usual, because interest capping has lasted. Still not repealed, so we've kept on. And the business model so far has focused on non-funded income because of the strain in lending. We're focused on efficiency in treasury. We are focused on the geographical expansion, and now you can see we have changed the structure to really focus on that. We're focused on innovation and digitization. We're focused on efficiency and cost optimization and asset quality. And of course, broad development and social impact in society. So those are the 8 thematic areas that have governed the bank, that defined the business model. So it's not purely intermediation. But we can't wait now for the opportunities that come, particularly with the private sector, and the repeal of the interest capping, if it happens, because then the bank will have 2 engines. The engine that was developed outside traditional lending, and if the risk pricing in the traditional intermediation comes, then the bank will be really strongly well positioned. So if we look at the performance of each of the thematic areas, we see non-funded income consistently improving. As we can see, loan interest income, we shot down from 23 billion to 16 billion, lost 5 billion. But as we can see, we have started growing again in credit, and we have regained 1 billion shillings. But if you look at the total interest income, when you look non-treasury income and loan interest income, because of efficiency in interest income, that gap of 5 billion has now been reduced to just 1 billion. Last year, but one total income as at 30th June was 26 billion. We have bounced back to 25 billion, almost bridging the gap. And then when you look at non-funded income, that has jumped from 11 billion to 13 billion. And as a result, when you look at the total group position, total income, we are better than we were at 2016. In just 1 year, the bank has fully recovered. The income as at June 2016 was 32 billion. We are now 33 billion shillings, if you load up the numbers. And so the strategy of rethinking income has been very, very successful. Very, very successful. That despite losing 40% of loan interest income in Kenya, we have fully recovered that within 1 year to bounce back and continue with our journey of transforming lives and empowering our people. As if we look at the specifics, we can see the fees and the commission, the other incomes that and we can see the momentum, that even if the lending engine comes back, the momentum is still there. The new lines of business are growing significantly fast. And particularly, I would like to highlight diaspora banking, which again we have streamlined and given it a complete director to focus on it. It's now larger than any branch that we have, and significant growth. We have also seen gross merchant banking becoming big, trade finance becoming big. So it is a diversified portfolio of income. We are very impressed with the treasury, and treasury, as we said, became the net. And we continue to say the government has crowded out. The public sector has crowded out the private sector. And we can see that is where the fastest growth is coming from. A growth, I guess, this year of 37%. And we can see treasury income as a result will become a major driver of that growth in income. We can see a 7% growth in income. But more importantly, is the efficiency with which it has been managed. And we can see the mix such that it's not just loan growth alone. And then we see that the movement in the marketplace, although the yields have come down, the mark-to-market gains that have not been realized have increased beyond 1 billion shillings. So again, all credit goes to our Group Director of Treasury and his team, James Mutuku. I mean, it's a good time to recognize a very efficient operation team that has... Gashao, Daniel, are you in the room? So that team has really helped. The second one is the area the Group Executive Director have been assigned, looking at the subsidiaries. And as we can see, the subsidiaries have really evolved. We see the total assets of the subsidiaries have grown by 21% to reach 142 billion shillings. We have seen that their contribution to the asset as a result has increased from 23% to 26% of the total budget. They are no longer the tiny startups. They now matured to a level that they have overcome all their cost, and any incremental income significantly increase profitability because the costs have been covered. We see they are contributing now 25% of all the deposits of the group, But most important is the growth of their profitability at 62% to increase the contribution of those subsidiaries to the group profit from 13% to 18%. They become fairly significant. And if you look at the quantum, 2.6 billion shillings is fairly significant and would compare to a tier 2 bank in Kenya. So it's really a significant contribution. And that is for that reason that the board in its wisdom have decided to assign that responsibility to Mary Wamai to ensure the sustained growth. As we can see, the regional subsidiaries will be more efficient because, as you can see, the numbers of branches are not as many as Kenya. Of all the branches we have, 283, next slide, Alex, 177 are Kenyan. And so you could see the subsidiaries are bringing on board just over 100, less than, just over 100, 113, if we may, less than the total branch network. And yet they are able to cover 5 additional countries. So agency, mobile banking. So we expect these subsidiaries to be very efficient. And I will not be surprised that in 2 years, they should be able to contribute to 40% of the profitability of the group. Unless, Mary, you have a different opinion. Oh, in 1 year. Thank you very much. May it happen. So essential, the second question is then, with all these situations, how do we manage the situation? Remember, we came from an environment of uncertainty, 3 countries with elections, South Sudan and DRC with huge headwinds. And so we took a conservative approach and said, yes, let's be conservative, but let's prepare ourselves for a changing environment. So we focused on making the balance sheet agile, such that if the environment changes, then we'll be very well positioned. And I'm glad that we didn't have to wait for too long. We are now very optimistic. We are very bullish about the future. We can look at you straight into the eyes and say, better days are ahead. And simply, then that change, dramatic change of situation in South Sudan, dramatic change in situation in Kenya, dramatic change of situation in DRC. And particularly, we are excited about the Big Four. And the reason why we are excited about the Big Four is the government has moved away from infrastructure to the real economy. Equity will be the biggest beneficiary, because when you talk about agriculture, that's where 120 branches are spread. So we'll disproportionately drive the agenda of food security. When you talk about low-cost housing, affordable low-cost housing, then again, equity will be the major player, being the inclusive bank that it is. When you talk about health, with 12.5 million customers, equity will be the biggest beneficiary of it. And when you talk about manufacturing, with a balance sheet of 550, then there is no manufacturing factory or sector that we can't be able to fund. We have the balance sheet to be able to handle. And particularly with our new approach of ecosystem banking, then it becomes much easier for us. So we feel that although Mary has told us in 1 year will contribute, maybe Kenya should push back because of better environment. Because it's not about standard gauge rail line now, it's not about LAPSSET, it's anchoring the rapid growth of 6+ points to the people. And once the money goes to the pockets of the people, it ends up in Equity Bank because 60% of the population bank with equity. Whichever way you look at it, equity is on the runway, and the future looks like very, very bright. The crowds have dissipated. We can see and we can look at our shareholders. And that we see that balance sheet very well expressed in terms of liquidity. And you could imagine 60% of all our resources, Alex, next slide, being in cash and near cash. Alex, next slide. Next one. Yeah, that is what we are talking about. Huge capability. Cash in hand. Is it about mortgages for affordable housing? Out of the 500,000, Equity can roll out easily 300,000 loans, because this liquidity means about 200 billion shillings. Treasury bills alone are at 160 billion, and it's quickly converting that. Factories that are being set easily, we can be able to cash and fund those factories. Farmers, agro-processing, all that can really be turned quickly into opportunities. And I want to applaud the management for the wisdom and the insight that made them to prepare us so well for the opportunities, having greater hope into the future. But as this happens, as the opportunities crystallize, they are crystallizing at a moment when the bank is very, very ready through its innovation agenda. If we look at it, can Equity be able to handle 60, 50, 70, 100 million customers? The answer is yes. And we don't need any longer to open more branches. As we saw, Kenya has more branches than the other 5 countries put together, because the future is not about the banking being a place where you go to. It's what you do on your devices. And as we can see, the mobile channel has really become significant. When so far, from January to date, branches has only handled 9 million transactions, just 9. A single-digit number of customers. The mobile has handled 277 million transactions. If we really divide that to be approximately 30 times, the mobile channel is handling 30 times more than the branches. You look at the agents who really have become the best bridge we could have ever had of helping digitization, digitizing cash through deposit and turning digital money back into cash using withdrawals. They handled 35 million transactions when ATMs only handled 11. So the banking model has completely changed. What does it mean? That when it comes to the agency and mobile, which are now handling, if you put those together, almost handling approximately 300 million transactions, while branches and agents are handling about 20 million transactions. What it means is that the model is no longer the brick and mortar. It has no assets to be financed, and it has no assets to be depreciated. And it has no fixed costs. Everything has become variable costs. The bulk of the transactions, 80, 90% of the transactions are now variable cost. And essentially that you'll see how this plays in the numbers, very significant play. And we are hoping the number of transactions increase. As they increase, we'll see more and more. And that is best depicted in the next slide, which channel is contributing what. And we see Equitel is still number 1, but after only 1 year, Equitel learns the risk of being overtaken by the Easy banking app. It appears now to be the most versatile. Equitel, as we all know, is a channel offered by the bank, but the app, you download it irrespective of the telecom that is servicing you. What has Equity been able to do? It has been able to plant itself through the app into the telecom clients. It's no longer the question of blocking Equity from having a SIM card or blocking the phones from allowing the thin SIM. Now that phase is over. The smartphones are here with us, and anybody can download, anybody who has a smartphone can download the Equity app. And for us, we are very excited because this is now new acquisitions. The Equity app represents acquisition from competition. It's no longer the traditional customers. And from the app, you can be able to open the account directly without coming to the bank. It's not like Equity where you need the SIM card. So essentially, that has changed the way we are doing. And again, the second one is agency. But more importantly, we are seeing now merchants becoming significant, and EasyBiz. EasyBiz is the corporate cash and liquidity management. And that is what is exciting us most, that our corporate clients, our large enterprises, our medium enterprises has also opted to digitize their transaction. Kenya was famous for the mobile phone, which was very personal and individual. But we have now been able to give internet banking to our business customers. And essentially, in another year, most likely, EasyBiz will be bigger than Equitel or Easy App in terms of number of transactions. And we really are able to remove the business transaction from the banking hall because they have been digitized. Then truly, the role of the branches will have to be redefined. There will be no transactions coming to the branches. Branches will be for high-value transaction. Branches will be for advisory. Branches will be for cross-selling. It's no longer transactions. Once you take the corporate, large enterprises, medium enterprises, transactions away from the branch, and put them to corporate internet banking, it's either the death of the branch as we know it or re-evolution of the branches to a different set and maybe doing services. The second area that we have really focused on is trying to build the capability of fintechs, and this particularly has been on the merchant space and money transfer. And we are very, very encouraged to see what has happened in merchant banking. I guess now, Batesh, we are headed to 60% of all merchant banking in the country. And amazingly, it's not just that. This will accelerate because American Express, or Amex, have opted to give exclusive rights of acquiring and issuing to Equity Bank for East and Central Africa. So it means that for the high net worth individuals, the Americans principally, then Equity becomes the exclusive bank. And that exclusivity means a lot. And particularly as the country takes off, that we can look forward to maybe processing 70% of all merchant banking in the very near future. That combination of all the global payment systems being put in one POS, the Equity POS, means that merchants don't require two POSs because Equity is able to cover. And I think it's only Equity that has that capability. That fintech capability has also been extended to diaspora money processing. And I think if there's anywhere we have made the strides, it's that space in diaspora banking. And diaspora banking, we have seen Kenyans become more confident. Alex is the next slide. To invest back home. I think the new constitutional dispensation, the Vision 2030 pursuit, transforming the country, have become very attractive. And what in the past we suffered as brain drain has started coming back as a brain gain. And it's not just brains that we are gaining massive financial resources that comes back with, and Equity has positioned itself very well with the fintech. I would say now we are bordering around 40% of all diaspora remittances are coming through Equity Bank. And this is an area that we would expect rapid growth as the fintech kick in, becoming more resilient, as we connect more and more, this is an area. And that's an area, again, we would like to recognize Jack and his colleague Patrice for a very commendable job. Jack, I know Patrice is in Uganda, but you can wave to be recognized for leading the fintech. That team has come out very, very well. And what is the impact of the fintech and digitization? Is that now Gerald Waloe, Director of Operations, Gerald Wave, has been relieved of 97% of all the transactions of his customers. As Director of Operations, 97% of all transactions are outside the branch. And that's what we were talking about, the mobile, the agency, and the merchant banking, and the fintech capability. And that's why we have said equity has been redefined completely. It's no longer the place you go to. It's what you do on your phone. It's what you do on your devices. And we are very excited. But I think it's the move. If you look, we have tried to give you a trend analysis. 2017 and 2018, we can see the mobile keeps on pushing its weight from 74% last year to date 78%. And we can see the branch from 4% to 3%. It means the branch is the real victim of digitization. That is as a little bit, and that's why we said we'll see more change, because when we look at value, last year, all that digitization was 48%, and the branch still handled corporate cash, about 52% of all cash. We have seen that has been reduced to 45%. So it appears Kenyans have accepted digital payments and has accepted the digital money. And that, again, is a phenomenon that will change business models in Kenya. And now what we are saying is that these 45% that has been left in the branch, we have given the solution to the corporate and say, do the same, but this time not on the mobile phone, but on corporate internet banking. Make your cash and liquidity management digital also. So once the corporates digitize their payments, then the 45 again will disappear, and hopefully by end of next year, we expect that not to be more than 25%. It will all have gone out, and that's why we said branches, we must find a new business for branches. And when you look at how that has been done, it has been done by our agents. If you look at part of the graph is faint, but the light gray color represents deposit, cash deposit. And you can see how much the money is leaving the mattress to the agents, how convenient it has come. That represents digitizing cash, because somebody goes with cash to the agent and they exchange their cash to a digital transaction on their account. So that completes digitizing their cash. When they want to convert back their digital currency into cash, it is marked by the gray, and you can see the gray columns are much shorter, maybe a third of what the orange beam. So withdrawals are minimal. What does it mean? It means Kenyans are becoming increasingly comfortable. Once they digitize their money, they don't convert it back to cash. They do digital payment. The landlord is paid digitally, the merchant is paid digitally, and we have seen what merchant banking has become. It's simply because of that digital money. And the success of Equity's digitization is because of this bridge that was created for us by 36,000 agents who helps us to convert cash to digital through deposit and back to cash, digital back to cash through withdrawals. That has not just happened in transactions, it has also happened in lending. And again, here, Elizabeth, maybe Elizabeth's loan book is now 93% of all loans that are processed and granted, we never see the customer. The customer applies for the loan on their mobile phone or on their devices, and the loan is granted and credited to their account. So essentially, again, credit have substantially been digitized, and we hope we'll continue to push this. And we can see again between 2017 and 2018, we have moved from 78% to 93% of all transactions. And only 7% of the loans are now handled in the branches, and where you have to do a file, only 7%. This is basically the big. The intention of the bank is that by the end of this year, all micro and small loans, again, will be fully digitized. And that, again, will take another 5%, push that to 97, 98, and we only be left with the 2% of the corporate loans or large enterprises being handled by the branches. And we have bought the system for that. We hope by end of next year, all loans will be originated online. So there will be no client who will need. So we have 3 systems: the consumer loans, now the micro loans, and now the big business loans system. So essentially that, and the outcome of all these is efficiency, significant efficiency, and it's best well reflected by looking at the cost-income ratio. And we can see over the year at the group level, the cost-income ratio have come down from 51 to 50%, 100 basis points on cost reduction. What does it mean? For every shilling the bank makes, 50 cents now is what covers the cost. The difference goes to the shareholders. So the bank, this is all about efficiency. And we can see, and this is the biggest testimony of the transformation of Equity. Everybody would have expected that with Equity being a microfinance bank, and the micro loans we all knew were being charged 18, that Equity forced now to be lending micro at 13 to be suffered significantly. But a combination of growth of other incomes and reduction of cost through digitization has brought efficiency, and at the end of the day, the bank then has a better cost-income ratio. And so whatever numbers then you see are now well explained. What explains the number? There is no magic. It is a business model, it's the acumen of the management team, and they have really focused and got it right. And we see the efficiencies. As we can see, it's not the top lines. If we look at yields, they have remained constant at 11%. We have seen that the costs have remained constant. And one then asks, with the reduction of income, how could you be more profitable? And the interest margin, as we have seen, remained constant. And that is explained by the efficiencies. The 100 basis point from 51 to 50 explains everything. And that, again, is supported by the asset quality, and we'll go through again there. Yeah, we have worked very hard to improve the asset quality of the bank. We've been performing well, but we must say that we have been pushed back a little bit. The quality of the loan book has deteriorated from 6 to 8% or NPLs, and that is explained. If we look at the large enterprises, it's where the challenge has come. We have 4 loans, delayed payment, loans properly secured, but they were expecting timing difference. I'm happy to say of the 4 loans, 2 have been paid already. And so we expect that other than for reporting purposes. So we would say we are close to back. Because the other 4 loans had to be provided for, we see the cost income, the provision. We'll see specific provision increasing by about 3 billion shillings we will see that. So that is well hedged, but as we have said again, once they are cleared through the payment, that will revert back. And the problem is specific to Kenya. So if you look at the other slide, where was this? We all know what is happening with county governments and central government delaying part of the payment. More of timing problem. We see the large enterprises in Kenya, and it's Kenya that has caused the group to strain. And we can see the coverage in Kenya declining a little bit because of the specific provision. So quality of the bank remains much better at 8%, when we know the industry is at 12%. So again, the strength of the bank is the quality of its asset book. I think just before then we go to the numbers, we want to remind our investors that Equity is an impact investment organization. It has very significant focus on social impact, and we continue to strengthen our contribution to society, investing significantly in scholarships, in leadership development, in agriculture, in health, in energy, and financial inclusion and entrepreneurship. And in the next slide, we can see the amounts that have been spent. So 34 billion shillings have been spent on our social impact projects, with the lion's share of that going to scholarships, both to the Wings to Fly, who have now reached 15,000, and as we speak, they're at Kenyatta University for their annual congress, and we see 10,000 of our scholars have now made it to university, almost 11,000. And of that 11,000, 461 have made it to global universities. But we are still investing significantly on our clients. So 600,000 of peasant farmers have been turned into agro-businesses, and we have almost 1.7 million customers receiving that 13-week financial literacy program. So in a nutshell, that's a bank. That is our story. What is the story by those who validate and reward businesses? And we continue to enjoy from Moody's a sovereign rating. That what it means is that for our clients, the risk they take by banking with us is as good as that of investing in treasury bills. It's equal to the government of Kenya rating. And that has been affirmed also by Global Credit Rating. And in terms of ranking, we represent the country as well as our long-distance runners in the arena of banking. We have made it to the top 1,000 banks in the world, but we are not well in size because we are Kenyan. We represent a small country in terms of population, but in terms of quality, when we get to the field of banking, we're still ranked the 11th best bank in terms of return on assets, and that is 7th best bank on earth in terms of solidness or soundness. The super brand status, 11th year in a row. We are very, very proud. We are also very, very proud that Euromoney this year also granted us the status of the best bank in Kenya. The Banker ranked as the best bank in Kenya, East Africa, and Africa. And Think Business granted us the status of the best overall bank in Kenya, Tier 1 bank, and best bank in SME, and almost every category, and a champion in each category. So the bank retains its health. The market has been very kind and generous to us. As at Thursday, yesterday, we still are 45 billion shillings better priced than any other bank in Kenya. We take pride that the market is willing to pay a premium for the quality that they get from Equity Bank. In terms of now the core business, intermediation, the balance sheet, we see the balance sheet has grown by 7 percentage points. That growth is driven significantly by growth in deposits, which have grown by 9% from 362 to 393 billion shillings. And we see the international community's confidence in Equity and the country. And we see our global lenders have increased their long-term lending for us to be able to support SMEs in long-term loans. They have increased their funding by 16%. And when it came to application, as we said, risk aversion because of interest capping, we see the government in one way or another crowding out the private sector. But as the model settles, as we take interest capping as the new norm, we now see loans starting to grow. And so far, we have registered a 4% growth rate in loans. And of course, that translates then into a P&L. And we see, for the first time, maybe after a year, interest income have now grown by 10%, driven by the growth in loan book. And we see net interest income, for the first time, now growing at 9%, and total income growing by 6%. And we see the application of efficiency and quality of asset. On quality of asset, remember this year we took the IFRS provision upfront for the total loan existing, and part of that now, because of the 4 loans, have been transferred to specific provisions. So we'll see. So it's the provisions is purely suspended interest. And staff cost, again, as we said, as the bank become more efficient, customers are on self-service platform, and other operating expenses, as we said, because of variable cost. And we see the total expenses for the 3rd year in a row continuing to decline. And we expect that decline to continue as we embrace more and more of variable cost. And that gives us a profit before tax of 15.5 billion shillings, up from 13.3 billion shillings, and a profit after tax growing by 18% from 9.4 billion to 11 billion shillings. Again, the product of significant efficiencies and significant diversification of our sources of income. And as we said, we would expect better results going forward as the microeconomic environment becomes suitable. For the shareholders, the return on average equity enhances from 22.3 to 24.5, as we saw the subsidiaries now kicked in, and return on average asset improving from 3.8 to 4.1. And investors are always keen not to generalize this figure. We see the contribution of each subsidiary. We are very excited that return on average equity, Uganda has now overtaken Kenya. And we hope all the other subsidiaries would overtake Kenya. So we were challenged. Can you replicate equity model in the other subsidiaries? And now this is the empirical evidence. Uganda is 10 years old, so it has almost come to maturity. And we see the subsidiaries that are 6 years old, they have kicked in. And I remember talking about South Sudan, bringing it to maintenance and ensuring it's not causing any bleeding. We can see also positive returns. And in terms of return on average assets, again, we see Kenya and Uganda now neck to neck. And that is why the strategy is grow the subsidiaries. If you grow the subsidiaries, because their cost outlay will not change, because they have sunk the cost already, then we'll see these numbers change dramatically. If there is any number that I expect to change dramatically, is return on asset and return on equity, because there will be disproportionate income growth to cost growth in the subsidiaries. So that gives us the cost-income ratio, which for us is a marker of efficiency. We see when we bought DRC Congo, it had a cost-income ratio of almost 97%, and in 2 years, we've been able to bring that cost-income ratio significantly down to 68, and that gives us confidence that these subsidiaries will be. And so we are really celebrating the changes that we have seen in DRC with the political risk. So how are we doing with ratios? The bank is in compliance with all the ratios, particularly that regulatory ratios, and for the business analyst is a table of all the ratios that we need to do. We are confident we can sustain. If you look at our core capital ratios at 18%, minimum is 14.5, it seems there is headroom for us to sustain growth that will come with the changing microeconomic environment, with the improving situation in the economy. Capital will not be a strain. So we can press the pedal, Batesh, Polycarp, and Mary continue to lead us. How are we doing with our projection? We had an outlook that we had given to customers. Loan growth, we had suggested 10 to 15. We're at around 4%. I'm very optimistic. If the interest capping is removed, we shall be able to be above 10 by the end of the year, with certainty, because we'll be able to price risk. Kenyans will be able to enjoy. Growth in deposit, we had projected between 5 and 15. We're at 8.3. Net interest margin, we are there, non-funded, just slightly below. Cost-income ratio, midway of where we had expected. We had given a range of... the reason why we gave range is we expected interest capping to be repealed, and if it is repealed, the game will change dramatically. Remember, we had 1.3 million borrowers before interest capping, but we couldn't accommodate 700,000 of those customers because their risk was higher than the sovereign risk, which is now at 13% maximum lending rate. So essentially, we would expect to be able to pull back our 700,000 borrowers. Why? Because today, they have gone to mobile loans, they have gone to fintech loans. How much are they paying? They are paying 5% per week. 5% per week, you multiply that by 52, it tells you that they are paying, is it 270? 52 times 5 is not 60, for sure. 260%. They are rational. And that is why I said I've been asked about interest. I repeat, the problem is not the interest capping. It's the way it was done. You can't equate the risk of micro businesses with the risk of government. Government is paying us a yield of 13.5 on infrastructure board, which is higher than the maximum interest rate we can charge to micro businesses of 13%. And that's how the government crowded out. So we are optimistic that those who are paying 260, as soon as Parliament, and I hope they will repeal, then they will be able to go back to a maximum of 18%. They will still be comfortable. They will be much better. They are paying 12, 15 times higher than they were paying in the bank. And maybe we see interest capping that perspective. I know I'm accused of being passionate. But if I'm not passionate for the members, who will? So push as much as we can. And we also about cost of risk, return on equity, slightly above almost where our entry point was. So in a nutshell, those are the numbers, and that is the performance. Brent, what haven't I said? Please. Brent is our group director of strategy, investor relations. Brent, some of the investors are here. Some of the analysts are here.
Great, thanks, James. I think James has gone through the story behind the numbers for the past performance, but I think key to highlight in the way the business is currently, you can see with the very liquid and nimble balance sheet, the group is positioned to take the opportunities that present themselves. We have, like James mentioned, a liquidity ratio of 60%, so that highlights that the group has a lot of capacity to grow, especially in an environment that the outlook is quite conducive relative to last year. But also important to the capacity to grow is when we utilize that capacity, and James has highlighted the efficiencies that are coming through with digitization, we can utilize that capacity at much lower operational costs. Bear in mind, you haven't really seen the power of the efficiency or the operational leverage, because a lot of the efficiency will really be reflected once we start lending. There's already very little efficiency gains that the group can obtain, because for Treasury to go buy a bond at the central bank costs very little. But when we start lending, you'll see the revenues improve significantly, but at the same time, the operational costs will remain relatively benign because of that operational leverage. So that efficiency that James is talking about, a lot of it will really be reflected in the numbers once the business is able to start lending again. And as James highlighted, we have a lot of capacity to lend. And what we do in Kenya, you can see we're making progress in these subsidiaries. So those are maybe just the key points I wanted to highlight.
Thank you. But efficiency. Is there anything we have left out? Very good. Polycarp, the mic is here for your first time in equity. How is the market? Our expectations, is our optimism misplaced? That political risk has almost declined dramatically? That the Big Four agenda is like a silver plate being handed to us because everybody is on the real economy. It's no longer about infrastructure. It's about money in the pockets of the people. It's about economic activities by the people. The optimism that we have, particularly of Kenya, is it misplaced?
Thank you very much, James, and good morning, ladies and gentlemen. As James mentions, definitely the region, the Eastern African region economically is on the windward side of fortune, primarily driven by political risk muting because of the election cycle, and especially in Kenya, the passionate appeal to actually release pricing of risk to be done by the market rather than by government is going to release lending. It's actually, we are affecting the market when you have 700,000 customers of a bank like ours going to borrow at 260%. That is a massive impact. And I think the pivot back into allowing the market to price risk will really help. And we are ready, led by James and the entire team, to go into ecosystem banking and to really put steroids on SME banking. Small, medium enterprises are the heart of our country. There are 7.4 million of them in this country. Only 1.6 million are licensed. And we want to approach those small, medium enterprises and give them cash flow, which is the bloodline of business. So very, very optimistic, and thank you very much, James. Thank you.
Just before we let you go,
Okay, yeah.
How, from coming from the consumer fast mover goods, a borrower from banks, and now leading to the sectors, where do you think we can improve to satisfy HACO, Tiger Industries, and Shell?
Okay, very good question. I think the market out there is waiting for cash flow lending. For a very long time, this market is about collateral lending. And the government and the regulator and all of us as banking players and business people, we are ready to pivot Equity Group into cash flow lending. And that cash flow lending will not be done, again, without allowing the market to price risk. And number two, coming from a consumer packaged goods industry, the heart of any economy is productive citizens in a productive economic environment. That's the heart of any product. So those two engines, productive citizens in a productive economic environment. So we are saying the economic environment is looking like it will turn positive. We are waiting for Parliament to do the right thing with the interest rate cap. But we are excited because coming from consumer packaged goods, what you will see from us going forward is we will not sit in branches waiting for orders from our customers. We will be out there as a team, knocking on the doors of hardware shops, of salons, of butcheries, of transporters, of contractors. We are coming to knock your doors to release this liquidity sitting in our balance sheet, 60% liquidity, 200 billion shillings to lend, and single lending obliga of 25 billion shillings. In English means we can lend a single business entity 25 billion. And also digitizing, with the help of Batesh and his team on the back end, digitizing, especially lending to small, medium enterprise business entities. We've digitized lending to individuals and the consumer, but we'll digitize and make it seamless to lend and give the customer experience to lend to small, medium enterprises. And James, to close, there is not a single large corporate, whether it's in the food and agriculture ecosystem, whether it's in the oil and gas ecosystem, whether it's construction, mining ecosystem, every large company there, and we have about 25 companies in Eastern Africa that do $500 million of revenue. But the balance of the business in East Africa is small, medium, and enterprises, and they are not breathing. They are looking for liquidity, and that liquidity is sitting with us in the industry, and we are ready to release it. And I think you've made a very passionate appeal, James, around what needs to be done to release that liquidity. That liquidity is sitting with banks and is sitting with government. Governments to start paying on time invoices to small, medium enterprises. That will be a great reward. And banks to then be released to lend to the same small, medium enterprises by being able to being allowed to price risk. Thank you for listening to me.
Thank you very much. That eloquence has now come to Equity Bank. So you can imagine how well we shall be able to articulate our solutions to the private sector. We now have an advocate of the private sector light in the mid of, on the table where decisions are made. Elizabeth, he has tried to preempt the questions on NPLs. Maybe you could come in and say what caused your NPLs to increase from 6 to 8, and the provisioning, the way it has been done, increasing provisions from 6 billion to 9 billion. And anything else about, we can then answer the questions before they're asked.
Thank you, James. I think you already alluded to it. Some of the key challenges you're facing, especially with our SME customers, is delays in payment by the county government and also arms of central government. So once the liquidity is released, we should see some of these customers being able to repay their loans. We also appreciate that there's quite a bit that is going on. And we're very
And
optimistic.
I'm very confident that the government will release liquidity because with a 6.2% GDP growth rate, the tax collection will increase significantly. So I'm not speaking on behalf of government, but as chairman of Vision 2030, I can promise that the government will honor its obligations soon, when it's able.
Thank you for that, James. And we are counting on your influence to enable us to do that. On provisioning, I know there's quite a bit about IFRS, coverage and all that, but I would say effective first quarter, we are now fully compliant and we are reporting as per IFRS 9 standards. Previously, quarter on quarter, we were more focused on central bank prudential guidelines, but this one has been overtaken because the requirement of IFRS 9 are more stringent compared to our local regulators' requirement on impairment, which means on a prudent basis, we prefer to report based on the stringent requirements, and we have already passed that number, as you saw in our first quarter reporting, and we are very optimistic that given the way we have looked and managed our book, the impact on coverage and provisioning is just temporal because we shall be able to manage our NPLs. Yes, there will be bumps, and I'm sure these bumps with time, as the economy normalizes, as more liquidity is pumped into the market, towards the end of the year, we should be able to see some of these things normalizing. But I would say our coverage, as reflected, is fully compliant with the central bank regulations, and it's also fully compliant with IFRS 9 reporting standards. Thank you.
Thank you very much, Elizabeth. Mary, you can see Kenya, we are set. Polycarp talked as if he only covers Kenya. Why do you think your region, or the region you are managing, will be able to push back and contribute 40% of the profits in the next, I still want to believe it's 2 years, although you are insisting in 1 year. But you can answer the question the way you choose.
Thank you. Good morning. I think I want to put James and the Kenyan team on notice to watch the space, what the subsidiaries can do, and what we are going to be able to do going forward. I think so far we have done very well. As you have seen, James has given us the numbers. And remember that performance has been on the backdrop of very young subsidiaries still setting up their governance structures, growing the management teams, really trying to understand the markets that they're operating in. And yet they've been able to do very well. Of course, very high investment cost, the initial cost of investments. But we seem to have overcome all that now. Just happy to report that 2 weeks ago, we were able to celebrate 10 years of our Ugandan subsidiary, 10-year anniversary. And that is very exciting for us as a group because if you remember, those who have been following the Equity Group story for a long time, Uganda had given us a lot of challenges in the past, for the first about 80 years. But all of a sudden, we've had a turnaround. We have a turnaround. We have a very strong management team now on the ground, a very, very supportive board, which is very, very involved in what the subsidiary is able to achieve. And we are very confident that we'll see very good things coming from that market going forward. And also on a light note, we were able to change the head office of Equity Uganda from the place we call Katwe to the High Street in Kampala. So what I'm saying is that the brand of Equity in Uganda has also changed dramatically. The reputation, the image of the institution is undergoing a massive transformation. And that probably explains also the good performance that we are recording from that market. And going forward, we should only expect to see a better performance from that market. DRC, very exciting. We had the cloud of elections, and the elections are yet to happen. But you have seen this year coming of tensions, and we are expecting that that will continue to the end of the year. So we are not expecting any significant challenge. Of course, the usual electioneering is going on, but we don't expect any significant challenges there. So we have a forecast team, and you have seen the numbers they're able to deliver so far. We are also lucky in the subsidiaries because we are able to export all the innovations that we have taken so much time to build in Kenya. Now they are ready for rollout in the region. All we are doing is plug and play. And the markets are receiving them very, very positively. We have already rolled out the easy products in most of the markets. By the way, South Sudan is rolling out agency now and mobile banking. So they are neck to neck, and they are also competing against each other, and we are allowing them. My responsibility is to make sure that the subsidiaries are given all the support that they require from the group. So I'll keep pushing for that. And so far, we've had a lot of support from the corporate office, led by Batesh and Polycarp. So with those resources, the systems in place, all the innovations happening, we should expect some very good stories coming from the subsidiaries. And thank you so much.
I've given you a hint as to who to ask the questions. So now I can facilitate the questions and direct them appropriately. It appears, colleagues, you have preempted all the questions.